Hi, everyone. Today I want to talk about Lending Club. A few weeks ago, they released their quarterly update, so let's talk about what was in there. Let's talk about how they've been reacting to this cough situation, and then let's do a portfolio update. As always, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like buying the new Gulfstream G700, go ahead and like and subscribe. It has seating for 13. It has a full-size bedroom, and it comes with a fully stocked bar, highly adjustable plush leather seats, and a dining area for two. Keep your dreams at the front of your mind, like and subscribe. Welcome to the Portfolio Bulletin. Let's get started. So the first thing I want to mention is that D quality notes were removed from the platform. These were the most risky notes. They used to have E and F and G notes, but those have all been removed in the past, and now they have removed D quality notes. And if you watched my Lending Club deep dive, you would know that the results for D quality notes have been sporadic. They had a wide range of returns. Sometimes you got lucky and got great returns, but the risk was certainly there to get an even lower return than any of the other notes. So because of that, they've removed D quality notes, and I think that was probably accelerated by this cough situation. They want to maximize the most quality notes and give themselves the best chance to weather this storm. And with that, let's get into the quarterly update. They start off here by talking about what's going on in the economy as a whole. They talk about how the economy is shut down, and they're unsure about the recovery and the rebound, as is everyone else. They also talk about how the Federal Reserve dropped rates down to between 0 and 0.25%, and how the Federal Reserve is providing liquidity to small business owners and to the financial markets. Moving on to platform observations, they are allowing a 2-month skip pay period for borrowers that are in hard financial times due to the cough situation. While I don't like this as an investor, meaning I might miss a few payments, I think in the long run this is going to preserve a lot of notes that would have potentially gone into late status. And based on the situation, it makes sense to me that they do this, even if it reduces my profits in the short term. It continues on here. 11% of borrowers have taken advantage of this program, which represents 13% of overall loan balances. And that data is through the end of April. It says here, out of those not enrolled in the hardship program, 91% of borrowers continue to pay on time, which is down approximately 6 to 7% from the March levels. It goes on mentioning that prepayments are down, which should be a benefit to investors. As people pay back their loans ahead of time, that reduces the amount of interest. This doesn't matter to me that much because as soon as I get those prepayments, I just invest those in new loans. But if you were planning to hold those loans and not reinvest, that might affect your overall portfolio. And in positive news, their rollover rate has actually stayed the same or gone down. Rollover rate is the rate at which loans go into later delinquencies, and the further they go into later delinquencies, the more likely they are to default and be charged off. So this is good to see from an investor perspective. The same amount of loans are going into default as before this cough situation. So that gives me confidence as an investor. Now we're getting into the pretty bad news here. The amount of loans was 83% smaller in April as compared to January, and they expect a 90% reduction quarter over quarter for the platform in Q2. So simply put, they're just not loaning as much money. They're not getting loan requests at the same rate. They're getting them at a significantly decreased rate, which might make it harder for investors to find loans. That remains to be seen. I haven't really noticed that. I've been finding plenty of loans to continue to invest in, but they're saying that they've had a pretty dramatic reduction in the amount of loan requests. In terms of existing portfolios, they don't list any changes. Continuing on here, they say that they've increased their collections and service capabilities by 30% in first quarter. And this is to help with collections and managing debt solutions. It says here that 90% of calls were answered within 20 seconds or less, which is what you want to see as an investor and as a borrower to help get your questions answered as quickly as possible. Here they expand on some of the debt relief options. They have a 3-month interest-only plan, and they have a 2-month skip payment plan. Pretty straightforward here, allowing borrowers to pay less in the short term. And then it says 90% of people that enrolled in either of these plans were current at the time, and that 78% of the people had never been delinquent, and 76% had never been delinquent on any kind of payments in the last 24 months. Approximately 90% of the 1,800 people surveyed thought that they could start making payments in 4 months or less. So this is all positive news. They're giving relief to some of these borrowers, and we still have faith in the people that are using these plans to start paying once this system is up, and that once people go back to work, they think they will be comfortable starting their payments again. So again, sounds good from an investor's perspective. It still remains to be seen if it comes true exactly the way it's listed here. They go on and talk about some of the tools that they're using to communicate with borrowers, increasing their capability to use email, text message, or phone calls, as well as a credit profile tracker, which allows Lending Club to see any changes in credit profile. It says here over 200,000 members have volunteered to be in the credit profile tracking system. They're not focused on growing loan volume. They're focused on supporting members and protecting investor returns. So essentially they're hunkering down just like the rest of the economy. Moving on to existing members, it says 85% of loans issued to date in second quarter have been to existing members, and that they use the data from their previous loans to issue new loans to these users. And that allows them to have better performing notes because they have data on how their first loan performed. They also have loyalty advantage programs to repeat users. And it says here 80% of members surveyed don't apply to any other company before requesting an additional loan from Lending Club. So essentially this is like a members program to Lending Club. Allows them to get repeat customers and better performing customers in terms of loan repayment. Again, more to do with hunkering down. They've reduced the amount of credit that they are investing in low quality loans. It says the results of this are a higher FICO score on average, lower risk grades, lower payment to income, shorter durations, and overall the FICO score has gone up about 15 points over 2019. And in late March, they also increased interest rates. So they're raising their standards to help protect investors and protect themselves during these times. Makes sense. Moving on to underwriting enhancements. This is where they go out and verify income, employment status, payment to income ratio. And it says they're improving their standards with this and doing a little bit more of it. And this goes along with the theme of everything else. They're raising their standards in order to protect themselves and investors. And in conclusion, they say they are uniquely fitted in deploying rapid credit to borrowers, and they have a 13-year track record of doing so, and they feel the community is strong, and they have been reached out to by a number of investors trying to see if they can help the company and help borrowers. Overall, this is a warming message from the company out to the investors and the borrowers. To illustrate some of the borrower improvements, the average FICO score it shows here has gone up by 15 points, which is what I mentioned. Average income is up by $16,000 per year. Average payment to income has gone down by 7 points. And joint applications have gone up by 4 points. So these are all things that are trending in a positive direction, which is something I would like to see. I like all of these things, and that makes me feel more secure investing with them. All right, for my account overview, my current annualized rate is 8.39%. That is up 0.7% from my last Lending Club video, which I believe was at the beginning of the month. This is my current account value, and I have some available cash here, so we're going to see if we can find some notes as an example. Otherwise, my current past due status is going down. Some of that is because notes are being charged off, and some of that is because people are paying their notes, even though they're in a late status. Overall, this is trending in the right direction. My annualized rate is going up, and I'm continuing to receive payments. You can see here my current note allocation. The hashing is the goal allocation, and the solid bars are my current allocation. Since there are no more D notes, there's no more hashing in the D note side. And I have moved more over to the C notes and then dispersed a little bit into A and B. So right now I'm under allocated on A, B, and C because there's so much still sitting in D notes. Moving on to manual investing, I always sort by FICO score first. So let's see what we got. We got a pretty high FICO score here and a 60-month B loan. Low amount requested. Let's see what that looks like. We got a verified income here, low payments, no job, kind of questionable, no credit history issues, pretty low revolving credit percentage. It's a little annoying to me that it doesn't have a job title here, but it does have a validated gross income. So I guess that can be overlooked. Whenever it has this little check mark here, it says that the income has been verified, and that makes me feel more comfortable. So I'm going to go ahead and invest in that one. Let's take a look at this 60-month A loan. So this looks pretty good. Low payments, only $20,000 requested, low debt to income ratio, mortgage. I mean, this is an A loan, so it's expected that these statistics are going to be good. So I'm going to go ahead and invest in that one also. Let's see what this high FICO score C note looks like. Okay, so we got a very high payment. They're requesting $35,000 in a 36-month period. Currently stating income as $6,250, no job title, renting, no length of employment. This sounds sketchy to me. I don't think I'm going to be doing this one. Let's take a look at this other 60-month A loan. Again, this is an A loan, so it's going to look much better. Low payments, mortgage, 10 years plus, job, extremely low debt to income ratio, high monthly income. Revolving credit balance is pretty high here. $58,000 is a lot of credit debt. Not sure exactly why it would be so high, but it's a pretty low revolving credit utilization and nothing in the last 2 years with the credit bureau. I'll go ahead and invest in that one. So I'm going to go ahead and place this order right now for these 3 notes. And then this is what it looks like when you're about to invest in these. Shows you what they think your projected return is going to be, historical averages, how much they expect you to pay in fees, and what they think the charge-off rate will be. I've been pretty consistently outperforming these with my strategy, so I don't pay too much attention to their historical averages. Let's go ahead and finish this. And placed. And that's how you manually invest in notes on Lending Club. Of course, this is all for entertainment. Consult your financial advisor before making any decisions with your own money. Go ahead and like and subscribe so you don't miss any of my future videos. And with that, let's get to today's jelly. So today's jelly is Philip Shabib. It's a throwback to his 2011 audition for So You Think You Can Dance. This guy has a crazy ability to make it look like he doesn't have bones in his arms. I don't really know how else to explain it, but watch it for yourself and you'll know what I mean. As you could tell, he could definitely do things with his body that don't seem possible and definitely don't seem natural. And with that, go ahead and like and subscribe so you don't miss any future episodes, and have a great day.